Hello everyone, this is DeLorenzo, President of United Asset Strategies. I'm joined today by Thomas Healy, the Director of Client Portfolio Analysis. It is July 2020 and I am so thankful that the first half of the year is now behind us. It's been a very challenging time for you, your families, and us as well. And I'm so glad that at United we have a mandate to uphold the highest standards of stewardship. It's helped to keep us grounded, to help you, and to help ourselves as associates within the firm. The first half of the year has been a little bit crazy in the stock market as well, and my opening remarks will be with regard to the Standard & Poor's 500, the 500 largest companies in America. As you may recall, the first quarter we saw a bear market and the market fell about 19.6% in the first 3 months. And although there's been a remarkable recovery, as now the market is only down 4%, there's been a divergence between growth and value that we're really going to take a closer look at right now. Growth stocks like technology and consumer discretionary have had an outstanding performance of about 16 and 11% respectively, most notably because of their ability to generate earnings that were equal to or even greater than before the virus began. But value stocks, traditionally known as energy or banking stocks, are down a whopping 40% energy, and I think it's 26% for the banking industry, primarily because of earnings that are not associated with a stable economic recovery. So we do think that value stocks eventually will revert to the mean, and Tom will cover some details later that might be able to put some clarity on the timing for that. The size has also contributed to the disparity inside of the returns of the top 500 companies. The top 10 companies by cap size have returned about 10% year to date, and now we're trading at a multiple of 33 times earnings. But the bottom 50 companies have had a negative 39% rate of return and now trade at 14 times earnings. So to help us to answer the question of why is this happening, why are the disparities, what's coming, I'm going to turn it over to Tom.
Thank you, Lee. One of the questions we've been grappling with the most is why the disconnect between the economy and maybe how people are feeling and also the stock market. And as Lee pointed to, a very narrow stock market. We think there are a few things at play here. The number one is the policy response. If you look at what Congress did following the shutdowns, they moved very quickly and in a very large way to provide relief. The most notable is the CARES Act. When you look at the size of that, that's about 10% of GDP that was replaced through congressional action. Also along those lines is the Federal Reserve. The Federal Reserve has increased the size of their balance sheet to about $7 trillion. Again, order of magnitude, about 13% of GDP. So when you think about the policy response, it represents about 23% of GDP that's been replaced, so to speak, by different policies. Now, when you compare that to 2008, that was about 6% in 2008. So it's been very, very significant. More recently, we've seen another thing at play here, and that's at the beginning of an economic recovery. Initially, with the shutdowns, you'd see all the data points that we look at went down steeply across the board. Now we're seeing as states begin to reopen. I think in New York, for example, here, we're in stage 4 of the opening. We're seeing the recovery in consumer confidence, industrial production, housing data, employment data starting to pick up. More recently, that's starting to flatten because some of these states like Florida, Texas, Arizona, California are seeing a surge in new cases, and they're slowing the reopening process. So that's something we're watching very closely as well. And then the third thing is the hopes of a vaccine. According to the Milken Institute, there are 179 vaccines that are currently on trial, about 20 of which are doing trials on actual people. This morning we had Pfizer announce they got fast-track designation on 2 of their vaccine candidates. So there's growing hopes that we'll have a vaccine in the next few quarters, and that's also fueling the market. So when you put all this together, we've seen a recovery in the overall market, but it's been very narrow, and that's because the economic recovery has been very, very short and not quite what the market has done. Now, we're also throwing out a note of caution. This is not a time to get complacent, and there's a few things that we're concerned about. I mentioned the economic recovery starting to stall. We also have what we're going to call a fiscal cliff coming. At the end of this month, some of the portions of the CARES Act are set to expire. The PPP program, unemployment benefits, it'll take an act of Congress to extend that, and right now there's no clear consensus on how that's going to play out. Another factor is now we're entering earnings season, and that's a big thing because last quarter most of the companies provided no guidance whatsoever on the outlook, and our analyst team is looking to see, is there going to be guidance, and if so, is it positive or negative? Again, when you look at the earnings disparity, you're seeing growth stocks with earnings down 8 to 10%, and value-oriented stocks, as Lee mentioned, energy, financials down 70 to 80%. So when the economy really starts to recover more sustainably, those earnings in those sectors will recover, and you'll see a recovery in those sectors. And of course, we have the election. We did a primer about 2 weeks ago on the election. We're still a little less than 4 months out. A lot can happen. We have to get a vice president candidate on the Democratic side. We have the conventions in August. We've got the debates that start in September. So there's a lot of things that have to happen between now and November, but we'll be watching that closely and we'll provide further communications. But again, there's just a lot of information going on, a lot of data, and we're watching all that very closely. So with that, I'll turn it back to Lee.
Thank you, Tom. Yeah, there's a lot going on in this country and the markets, the economy, and there's certainly a lot going on here at United Asset Strategies as well. You may recall about 1.5 years ago, we moved our offices to a larger suite and we grew the customer client experience team immediately. Well, we just added 2 more individuals since Memorial Day. One's name is Jordan Sanchez. He comes to us from Goldman Sachs. He's a CFA, he's an MBA, and he'll be covering the communications sector, and he'll be working directly with clients in their portfolios. We've also added a leader in business development, and Peter Ferdig, and he comes to us from Zacks Investment Management. To try to capitalize on the different tactical opportunities that have presented themselves in the market, we've also rolled out another new equity strategy. We call it TOPS, T-O-P-S, Tactical Opportunity Plus, and this might be of interest to some of you if you haven't heard about it yet. We have also had the honor of being interviewed by Barron's over the last several weeks, and the article is going to be published, I believe, next Saturday on July 18th, and they're going to highlight how we've built a team to serve the future, and I'm very excited about that. So there's a lot going on. United Asset is ready to serve you. We are hoping that if you have any changes in your personal situation, your business situation that we haven't yet addressed, that you'll reach out to us. Otherwise, you can look forward to hearing from your relation managers soon. Thank you, everybody, and stay safe.